Hi everyone, let me just share my screen. Okay. So let's start our session, right? So good afternoon everyone. Hope that you have your lunch already. So really appreciate all of you for taking your time off your busy schedule to join us here today. And my name is Alvin and I'm the research analyst for FSMOne Malaysia. And my topic for today will be on inflation and how investors could position themselves in this higher inflation and higher interest rate environment. So without any further ado, let's kickstart our session. So inflation, the biggest issue that the world is currently facing today that caught the eyes of investors all around the world can be summed up in one word, and that is inflation. In the past, we have been living in a low inflation and low interest rate environment for decades, and little of us have memories about the great stagflation back in the 1970s. As you can see here, inflation at that time was so high, and the Fed had no choice but to hike interest rate up to 20% to tame the outraged beast, which I'm here referring to it as inflation. So looking at where inflation stands today, it is at around 8.2%, and it's also at the 40 years high. So, and this doesn't just this issue, the inflationary pressure doesn't just face by US only. It applies to the rest of the world as well, as the rest of the central banks around the world are fighting to tame inflation down. So if you remember what the Fed says in the beginning of the year, it says that inflation is transitory and people don't need to be too worried about it. But clearly, look at where we are today. Clearly, he's wrong, and because not just the inflation data, the core inflation data, which measures the long-run price trend of and it excludes the transitory prices such as energy and food. And this data is currently at around 6.6%, and also it's at a 40-year high. So, how did this happen? 2 years ago, people were thanking the Fed's decision to implement the massive quantitative easing policy to save the economy from the COVID-19 pandemic. But at that point of time, some people already know that there isn't free lunch in this world, as the massive monetary supply, massive money supply will lead to more inflationary pressure lurking around every corner of the economy. But just because that we are so used to living in a low inflation period where inflation kind of just fluctuate between 2 to 4%, we kind of ignore the possibility of it getting even higher. So, and that seems all fine until this year, Black Swan event changes everything. The Russia-Ukraine war has caused commodity prices to skyrocket, and not to mention that the emphasis on green transition in the past has caused heavily underinvestment in all of many commodities, and has further worsened this situation. So how sticky is inflation today? I describe inflation as sticky because it is hard to shrug it off. In the beginning of the year, the inflation was mainly contributed by energy inflation. But as you can see, what are things today? And the energy prices has gone off their peaks already, and we see that there's the relationship between inflation and energy prices are kind of gone off the hook, as both natural gas and crude oil were off their peaks, and while inflation still remains elevated. So how is this happening? It's because of the service inflation, which is the better guide to the underlying price pressure of the economy, and this data is picking up. The US job market is still remain very strong, with unemployment rate at decades low, and growth wages are cracking up insanely. So why do I say that service inflation is more stickier than energy inflation? It is because when you see energy inflation, right, it's very subjected to like major commodity prices such as crude oil and natural gas. And if you remember back in when COVID-19 happened, right, the prices of the futures of crude oil once fell below like negative $37 per barrel, meaning that producers are actually paying money to get their oil off their hands because they don't want to bear the storage cost. And who could at that time who could imagine that after 2 years later oil prices could hit a high of $120 per barrel? And so that's why energy prices, energy inflation can be very volatile. Meanwhile, on the other side, service inflation, due to psychological manner, it is always easier to increase wages than to cutting wages, right? How often do you see a company cut its wage? So according to the IMF, right, the global inflation is about to be at 8.8% in 2022, 6.5% in 2023, and 4.1% in 2024. So it looks like the 6.5% in 2023 is still above the average inflation of in the past decade, meaning that inflation will still remain to stay elevated for much longer. And below the next few slides, I'll outline some of the reasons why we think so. First, higher oil prices. Oil prices will remain higher for much longer. This is because that the Russia-Ukraine war has caused commodity prices to skyrocket, right? Especially oil prices. And even at that time, the demand for oil isn't at its full capacity yet, because we have China still implementing the COVID-0 policy, and then we have many countries still under their lockdown measures. And although the oil prices have come down notably since June, oil prices are still substantially higher compared to last year. And we also expect demand for oil to remain to become more to get more and more moving forward, due to the revenge spending, as more and more countries open their economy and revenge traveling will occur also. So for example, Japan, right, who is in many tourist bucket lists, they have also reopened their economy in 1 week ago in the 11th of October. And I know that some of you here, the audience here, have maybe have families or friends have already bought their ticket to Japan also, right? And also, as we are moving more and more towards the end of the year, and we are seeing more and more countries entering into their winter seasons or even holiday seasons. So we'll expect to see more international travel to occur around the world. For example, especially in Europe, right, who is currently facing energy crisis, and thus they are more motivated to travel outside to maybe Southeast Asia or ASEAN countries to escape from the cold weather. So as you can see from this chart here, demand for oil tend to spike during the end of the year. As you can see in the past period, this keeps happening. So with this, we think that there will be strong pent-up demand for oil as travel makes its long-awaited return. Next, supply fears have exacerbated. Russia, who accounted for Europe's 41% of natural gas, 46% of solid fuel, and 26.9% of crude oil in 2020. And this after the outbreak of the COVID-19 of the Russia and Ukraine war, right? This has Europe has actually slapped a lot of sanctions to it. So this has caused their inflation to be kind of high because of they don't have access to so much energy, raw material, commodity anymore. And to further worsen these situations, the leakage of the Nord Stream 1 pipeline, I assume that you have heard the news, right? The Nord Stream 1 pipeline, the leakage of this pipeline has kind of completely cut off Europe from Russia's natural gas. And thus we expect this will cause higher prices for natural gas also moving forward. So next, the green transition will also contribute to a longer term inflation. So in the past few years, the emphasis on green transition has caused heavily underinvestment in in a lot of those traditional dirty energies such as coal, oil, and natural gas. As you can see, the global oil and gas upstream investment has been on a declining trend, and which has caused these commodities to be undersupplied to face lower production, lower supply, and also eventually cause higher prices for them. And also, we think that the green transition is likely to create huge boom in demand for those precious metals such as nickel, cobalt, lithium, and copper, which are very vital for technologies underpinning everything from electric vehicles to renewables energies. But the matter of fact is that these precious metals are in vastly low shortage of supply. According to IMF, the nickel and cobalt are vastly inadequate to cater to future needs, and their supply and demand gap is around 66%, which means that demand is higher than supply by 66%. Meanwhile, copper and lithium is also vastly inadequate to cater to future needs, and with a supply and demand gap of around 30 to 40%. We do not expect the supply of these metals to ramp up quickly. This is because the investment in mines has been greatly depressed by ESG concerns, and these ESG concerns has forced miners to source metals more responsibly. So herein lies the paradox of the more harder the world pushes towards a greener economy, the more expensive that these metals will be. And we should be under no illusion that the green transition will be a painless one. So next, food prices to continue its upward trajectory. The Russia-Ukraine war also has been one of the major contributors for such high food prices, and unsurprisingly so, because both of these countries are major powerhouses for agriculture. So one of the key things we see is the price of fertilizers, because everything we eat, such as the vegetables, although it depends on fertilizers, right? So fertilizers is getting more and more expensive, as you can see from this chart here. And in Europe, due to higher input prices and also higher increasing natural gas prices, this has dampened the production of ammonia, which is a key ingredient for the nitrogen-based fertilizers. And also similarly, China has limited its export of phosphate, which is another key ingredient for the fertilizers. And thus, in order they wanted to protect their local supplies. And also the climate change has put a challenge towards crop yields, because good harvest needs good or at least moderate weather. But then this year, farmer has been constantly confronted with with extreme weathers. For example, China, who is one of the largest wheat largest wheat producer, they are facing lower rainfalls and also one of the most severe heat waves in the past 6 decades. And this has vastly impacted their crop yields. Also, food protectionism has been kind of a trend moving into this year, with more and more governments implementing food protectionism to safeguard their local supplies. For example, India, which is the largest rice exporter, has been discussing curbs on its rice exports to ensure that they have enough supply for their domestic needs. And this has caused Asian countries to be hit the most. And also Indonesia in April, they banned the palm oil exports as global food inflation spikes, while Malaysia, we also banned our chicken exports due to ensure that we have enough supplies to cater to domestic needs. And so from here we can see that these countries aren't the first who implement this food protectionism, and believe me or not, surely they won't be the last one. So consumers should expect higher food prices from here. So according to the above mentioned reasons, it looks like higher inflation is to persist. But on the positive side, though, we think that the peak inflation has passed. Inflation projections have jumped significantly from the start of the year. As you can see from this table, it shows the Bloomberg estimate of inflation. The world data here shows that the world inflation is about to be 7.2% in 2022, 4.6% in 2023, and 3.3% in 2024. Whereas when we look at the IMF, right, they are predicting inflation to be at around 8.8% in 2022, 6.5% in 2023, and 4.1% in 2024. The similarity between these two agents is that inflation will moderate, but will still be elevated and it will still be above Fed's 2% target rate. And although inflation will be elevated, we think that it will moderate. As you can see, it won't be surpassing the highest already. So with inflation is expected to remain elevated for the years and months ahead, we think that monetary policy tightening is inevitable to curb inflation. And we have raised our forecast for the US interest rate from 3.25% to 4.25% by the end of 2022. And we expect other central banks to follow the Fed's footsteps, even for those economies that doesn't face very great inflationary pressure. Why is this happening? This is because when US hike their rates, right? And US is considered that to be a risk-free rate already. So when they hike their rates, this will, and other economies doesn't hike their rates, this will cause an outflow from these economies back to US, as this is because US they offer higher rates with lower risk. So if you are an investor, you will be also keen to invest in US, right? So this will cause a huge outflows from other regions back to US, and which will cause demand for dollar to increase, and subsequently of devaluation of other countries under the currency for other countries. So so other countries will, even if they doesn't face huge inflationary pressure, they'll hike rates as well to support their currency. For example, for Hong Kong, right, their inflation currently is at 1.9%, but it has already increased their interest rates from 0.5% in January to 3.5% currently. Whereas Malaysia, our inflation is at about 4.7%, but we have already hiked rates 3 times this year. So does the huge devaluation of currency across the world bring something in investors' mind? Some of you might remember of the Asian financial crisis back in 1999. But we think that this situation, the Asian financial crisis, will not be re-happening again, because that although yes, the devaluation of currency is a major issue, but then our government's loan books, their balance sheet is much more healthier than before. At the past, right, during the Asian financial crisis, the Asians' foreign debt to GDP is at around 75%, but currently we stood at around 30 to 40%. So we don't see a reoccurrence of Asian financial crisis yet. Yeah, so yes, we are still, because of we have stronger and healthier balance sheet than before. So after all, we have learned how inflation going to be elevated moving forward. So here's how investors could position for a new era of higher inflation and higher interest rates. First, investors could consider to invest in price setters and avoid price takers. So who are price setters and who are price takers? Price setters are those who has the pricing ability, and mostly they are demand inelastic, means that any changes in demand wouldn't affect the price. Any changes in price will bring minimal impact to the demand. And these are typically companies with strong unique value propositions and market positioning. And these are the companies that fund managers look for. For example, TSMC, who has raised its prices of its semiconductors by a few percentage points back in May. And even if that happens in its third quarter earnings, it has recorded a huge profit surge of 80%, and it is the fastest growing pace since 2 years ago. So it shows that despite I raised my price, demand is still there. There's still high demand for my product. So these are, and also LVMH and also Lego has announced to raise its price, and when they think that investors or consumers wouldn't mind. So these are what some of the companies we are trying to look for. And also for a local brand, Massimo, right? They announced to increase their most of these rates by around 10 to 60 cents. And they think that this wouldn't bring a huge impact towards their demand because Massimo is still very locally favored brand, and also their major competitor Gardenia has also raised their price previously. So they think that this price hike wouldn't impact their demand very much. Also, on the other side, we advise to avoid price taker. So who are price takers? Price takers are companies that doesn't have such strong pricing power, and also they, for example, wholesalers such as Amazon, Walmart, and Target issues profit warnings because they face higher input costs. So in short, we advise investors to try to find price setters and avoid price takers during this high inflationary, high interest rate environments. Next, avoid highly leveraged companies. So this is because highly leveraged companies, they're actually depending on a lot of refinancing their loans to sustain their businesses. And when interest rate is high, right, this will cause higher borrowing costs, which will cause borrowing costs to increase. This could add burden to the highly leveraged companies, which will impact their profitability and earnings. So some sectors that we like with that has low leverage are such as those like tech stock, and also other like consumers, while highly leveraged companies are in sectors such as energy, utilities, and also banks are not very high leverage, but they're still like in the middle. But and then when you look at this table below, we know that it looks like developed economies has lower leverage compared to emerging economies, right? But the thing here is developed economies face lower inflationary pressure, and also the pace of their central bank's hiking rate is also developed nation faces higher inflationary pressure, and their pace of their rate hiking is also faster. So thus we think that the developed economies is more vulnerable to higher interest rates, to interest rate hikes. Next, we think that value stocks are back in play after decades of underperforming growth. And if you look at this chart on your right hand side, right, this basically shows the return dispersions of the value stocks versus growth stocks. Basically, it means that if you see an uptrend, right, it shows that value is outperforming growth, while vice versa, a downtrend means that value is underperforming growth. Notably, if you see from 2007, right, this index has been on a declining trend, showing that growth has gotten the likes of investors, and growth stocks is constantly outperforming value stocks. However, if we look into the history, right, value tends to outperform during Fed rate hike cycle, especially early in the cycle. As you can see here, they outperform, here they outperform, here they also outperform, here they outperform also, here they slightly outperform early in the cycle. And also we can see that there's a slight uptick already in current, and also we expect more upside potential for value stocks to outperform growth moving forward in this rate hiking cycle. Why is it? This is because the value composition primarily overweight inflation sensitive cyclical sectors such as energy, financials, and utilities, who will perform good during high inflation and high interest rate environment. Meanwhile, they underweight sectors that will got the hardest hit, such as technology, consumer discretionary, and also healthcare. So it's not that we recommend investors to like sell all your growth stocks, No, we are considering our view on value and growth, right? We recommend to hold a combination of both. Because as I mentioned earlier, right, since 2007, growth stocks has been constantly outperformed value. This has caused a lot of investors' portfolio to skew towards growth, and perhaps they should now consider to diversify away and add value exposures. Next, look for beaten down assets with good fundamentals. So this is also using the thing of value investing. As I know that maybe some of you here saw this before, that Warren Buffett is actually getting greedier when there's bird in the market. So based on the regulatory filings in the first quarter, Berkshire Hathaway, which is Warren Buffett's company, invested around 40 billion in as he sees more investment opportunities. And also, he has added a lot of stakes in Citigroup, Paramount Global, and Ali Financial. He also added 2 sizable purchases in energy companies such as Chevron and Occidental Petroleum. And furthermore, in the second quarter, he has invested another 3.8 billion US dollar, and mainly in these 2 energy companies, the Chevron and Occidental Petroleum. So it says like Warren Buffett has been a man of his words, as he invests when other people are fear. He being greedy and when other people is fear. And so we advise investors to look for beaten down assets with good fundamentals. So where are the opportunities lying? So if from this chart, you will see that most of the opportunities, this in the chart on the left-hand side, right, we rank the regions under our coverage from the most attractive one to the least attractive one, from the left to the right. And all of these regions, we measure their attractiveness based on its upside potential. So basically, it means that the higher the upside potential it is, the more greater it is, the more attractive it is. So you can see that we are deriving the upside potential by dividing the fair PE ratio, the price earnings ratio, by the forward price earnings ratio. So basically, a higher fair price earnings ratio is that what the company is worth it, and the forward PE ratio is that what is now worthing it, what is now worthing. So the higher the gap it is, the higher the upside potential it is. So you can see that most of the opportunities, the most attractive regions are nonetheless from Brazil, Taiwan, China, and Asia, and also Hong Kong and South Korea. So it looks like the biggest opportunities can be found in Asia, right? So in Asia, this is because of the following few reasons. We like Asia because of, first, there will be benefit from the reopening play. As I mentioned earlier, we are moving more and more towards the end of the year, where there's winter seasons and there's holiday seasons, and more international travel will happen, especially in the ASEAN countries and also Southeast Asia countries. Next, China's policy backdrop remains accommodative, as we are likely to see the end of the headwinds in China already. And also, as you know, Asia, the earnings for Asia equities has been downgraded quite a lot this year, and we think that this shows a great opportunity, as there is scope and room for earnings surprise. So if you look at the most very attractive one, you see we assign, based on the stars, right, you can see we assign the most stars towards China and Hong Kong. Why is that? Some people might ask, China has been facing a lot of negative headwinds in this year, right? So why are you still showing ranking it as the most attractive regions? So basically we rank it as our most attractive region is because that we think that the sell-off has actually too overly, and it's very undervalued already. Because who are we talking about? We are talking about the second largest economy in the entire world, and now it is trading at around 2010 levels. How is it not attractive for investors? And I know that looking at what the government is doing is that if you know China, right, it has been one of the fastest growing economy in the entire world. And what does history teaches us about growing too fast is that it will create a bubble. And um, so what we see that from the Chinese government, they are actually trying to all of this COVID zero policy, the regulatory crackdowns on education, delivery, technology, and also property. So what are they doing is that they are trying to pop the bubble before it becomes too big. One example I have here is Japan, who has experienced a pop in its asset price bubble uh, in the 1990s, and after 2 decades until today, they still struggle to recoup their losses. And people often refer to it as lost decades for Japan. So the Chinese government, they are trying to avoid repeating such mistakes by all these policy regulatory crackdowns. And thus, we think that this is not the end for China. And we think that also this shows a very good opportunity to invest in China also. So when you look at the regions that we underweight is from nonetheless from India and developed nations. This is because these nations faces higher inflationary pressures, and also they faces their earnings has been too overly optimistic, and we expect to see a downgrade in earnings soon, which will heavily impact their equities, the performance of their equities. So before we end here, right, I would like to say why we choose ETF, why we choose unit trust. Sorry. First, it based on the reasons I mentioned above, right? Although there are a lot of negative sentiments surrounding the entire world, right? But we are still seeing some good opportunities lying around, and with that, investors have to do a lot of homework and a lot of research need to be done to select the right stocks to invest in. Yet instead, why not leverage on fund managers' expertise by buying their unit trust and entrusting them, leaving the responsibility of generating capital gain to them? So I know that some of you here might be very active investors, might be very active traders who invest quite often, and you might be very familiar with like Malaysia region or something. But the thing is, how many regions can you be familiar with? One or at most two? So if you look in the past, right, after the COVID-19 outbreak, right, the Malaysian equities has experienced quite a rally, but it's nothing compared to like China or US. So if you are like too focused on the Malaysian equities, like you will miss out other opportunities in other regions. Like in the beginning of the year also, right, we have major sell-off in many countries. Every equities got so beaten up, but Brazil is performing good, and also currently India is also performing good. So if we are like too focused on one region, we kind of miss out opportunities in elsewhere, and that's how the fund managers come in place to help us save all the time and all the effort that we need to go through to study to select a stock to invest in. So in FSMOne, right, we offer a platform for investors to buy and sell unit trusts. And we also have our in-house research analysts who will provide investment ideas and also recommend regions to investors and that are attractive. So, and also we have also allowed investors to trade stocks by from different exchanges, such as we have Hong Kong, China A shares, which normally you don't see it at other exchanges, right? And also we have Malaysia stocks and US stocks and more and other things else. So yeah, this is why you should invest in unit trust also, even if you are a stock trader. So when I come to almost the end of my presentation, right, here are some key takeaways that I hope that you have in mind on how you position yourself for a new era of higher inflation and higher interest rates. So it looks like with all of these factors, such as the higher oil prices to be much more longer, and green transition, and also higher food prices, and also higher. We think that we think that low inflation is gone for good and for the time being, while interest rates are going up. So we advise investors to consider to reposition themselves in the era of higher inflation and high interest rate by firstly selecting price setters and avoid price takers. Next, avoid highly leveraged companies. And third, which we advise investors to have a combination of both value stocks and also growth stocks in their portfolio. And lastly, look for beaten down assets with good fundamentals. And some opportunities that we see is around Asia, such as China, Hong Kong, Korea, Taiwan, Singapore, Indonesia, and Malaysia. And we always sectors such as financials and healthcare. So I think that's all for my today's presentation. Is there any questions? Let me see if there are any questions. Okay, the first question is, can you repeat the definition of price taker? So, okay, price taker, unlike price setters, they don't have the pricing power. That means that they need to follow the market because they are at like a market with fierce competition and low product differentiation. So that means that your competitor might be offering almost the same thing as you. So you cannot be like charging higher price because your customers will easily switch towards the competitors already. So that's the definition of price taker. So they need to take the price from the market instead of setting the price themselves. Okay. So next question. How many years more will we be in high inflation? We think that what's the development in the world currently, how the world is unfolding, is that we think that we don't have the exact timeline for it, but we think that it's not going to moderate back to 2% or the inflation rate soon, because all of the thing that unfold has actually changes the entire how the world works. If you can see, like let's say higher oil prices, and also that recently US just banned China's export, right? They actually, if you know the chips exports, right, exports chips to China, sorry. So if you know how the semiconductor industry works, it's basically like every country do a big part in the entire supply chain. For example, US, they are the one who very expert in designing chips. And after designing chips, right, they need to manufacture such chips. And that's how China and Taiwan comes in place. They are very expert in manufacturing chips. And also for the downstream, right, we have countries like also China and Malaysia who is expert in packaging and also testing the chips. So each player from the entire world plays a huge role in the semiconductor industry. So with like this, the US slaps sanctions towards China, right? That means that they have to design the chip themselves, and this causes more inflationary pressure around the world. So because like you can't depend on other countries anymore. You have to use your own methods, own supplies. So everyone will be fighting for all of these supplies. So this will cause the inflation to persist even longer. And also you see food protectionism that isn't very trendy before this has been kind of a trend today, as more and more people are putting efforts in it already. So we don't think that inflation will moderate soon, at least for the next few years. In the near term, do you believe that the ringgit will regain ground against US dollars, seeing that Bank Negara Malaysia will not raise rates as much as Fed? Regain ground as mean a rebound, because currently the ringgit to dollar is at around 4.7 ringgit per dollar, right? We think that this is because of a lot of exporters, right? Because some might ask that we are a net exporter. Our country is a net exporter. Why is ringgit still suffers so much against US, right? Because for ringgit, right, a lot of exporters has actually they hold on to their US dollar and not selling it. That's why with this exporter not selling US dollar, right, the ringgit wouldn't have much support for it. So we are likely to see more downside pressure for for the ringgit Malaysia against the US dollar. But the good news is that on a relative basis, ringgit hasn't been depreciated much compared to other regions such as Hong Kong, China, or even Japan. So we are holding quite well compared to our regional peers. But still, the higher dollar will affect us as well, but it will benefit us as an exporter. So we think that ringgit will in the near term will not be we won't see a huge rebound in ringgit against dollar. Yeah. So that's all for this question. Why is it overweight in Asia despite China and Hong Kong valuation is cheap now? So it's basically just that because that China and Hong Kong is trading at super cheap valuation, we overweight these regions as we think that most of the opportunities, upside potential lies within these nations. Like let's say the property crisis, right? Although we see that the China consumer have already been the consumer confidence is at very low point because of the property crisis. But we think that it's not the end for China yet because China has one of the largest consumer market and it's trading now at like we think that all of this is just a sentiment issue and it's trading now like so cheap valuation. So it's really propose a very good opportunities for investors to get their hands on some of the big names or some of the companies that is so expensive in the past. So yeah, that's why we think that China and Hong Kong is very cheap now. So from more opportunities in Asia, right? We see higher opportunities in first Thailand, right? Because Thailand, they have although they will be benefit very hugely from the reopening of a lot of countries uh, from from uh from a lot of countries, right? Because there will be revenge traveling around the world and much more. And also the energy crisis in Europe, right? Where they face very extreme cold weather. And when they are entering into a cold seasons, winter seasons, right, then they don't have enough natural gas. And with all of the electricity prices so being so high, right, they will be more inclined to travel to like Southeast Asia, and Thailand will be one of their major destination. And Thailand is also very heavily tourism sector, so they will be benefited it through more Europe tourists and more prolonged stays. Okay, so the question of the ASEAN will lose their shine in this high inflationary environment is I already answered in the previous questions, right? So I hope it helped. What the next question is an interesting one. So what time frame you believe that China and Hong Kong stock markets will recover? Within 6 months or 2 years? So we think that although we do not have an exact timeline or any forecast yet, we think that things was getting better after this NPC, the 20 National Party Congress. Although Xi Jinping is going into his unprecedented third year term, and he already expressed that he remain strict on his COVID-19 zero policy and every regulatory crackdowns, right? He remains strict on that. And but still, we think that with more certainties being priced in already, we think that we'll see China and Hong Kong stocks to rebound very soon. And once the timeline, the best case is that after they lifted their COVID-0 policy, and that's when everything starts getting better. And also one thing of the Asian markets, right? Just now the question I forgot, I would like to add on, like, is that Asia markets will be benefited also from higher foreign direct investment. As if you do pay attention, is that how the Europe's wanted to solve the leakage of the Nord Stream 1 pipeline, let's say, has caused why they do it so is that because US wanted, like, some say it's US did broke the pipeline, right? But until now we don't know who's the exact one yet. But one of the motive US if they did it was to first either put more reliance on because if they don't have the direct supply of natural gas, right, Europe need to depend on the LNG, which is the liquefied natural gas, and the two main exporter will be first Qatar, next US, right? So another thing is that with Europe unlikely to import so much liquefied natural gas, they will go for limiting manufacturing industrials like energy usage, and this will hit their domestic and manufacturing and industrial sector very heavily, and which will cause a lot of a lot of European firms to relocate their factories or manufacturing sector to outside of US, to outside of Europe, and firstly they might go to US or Asia countries, which has a lot of good opportunities such as lower wages and also better government support. So yeah, they will be Asia will be one of the major beneficiaries of this as well. So I guess that's all for today, and thank you all for your questions and your time for being here. I hope that you have get something insightful from this presentation, from this session. Okay, so thank you all, and I hope to see you soon. Yeah, thank you.